Hi there, in this video, we'll explain commonly missed self-assessment expenses for UK personal trainers and coaches, helping you claim correctly and stay compliant.
Imagine you're a self-employed personal trainer here in the UK. Let's say you're earning around £40,000 a year, and you're getting ready to prep your 2026/27 self-assessment. Are you missing out on thousands in legitimate expenses? Or even worse, are you accidentally falling into a massive compliance trap? Hello, and welcome to this explainer. Today, we're partnering with My Tax Accountant, or MTA. They're a premier UK accounting firm that specializes in helping businesses navigate the very strict HMRC regulations. And this discussion has been put together directly by MTA's tax advisors. We're zeroing in on a scenario that trips up so many UK self-employed personal trainers and online coaches. Basically, if you're a sole trader earning anywhere between £30,000 and £80,000 a year, there are some absolutely crucial nuances to your expenses that really require professional attention before you hit submit on that return. So let's start with a highly practical scenario that comes up all the time. Are your new 120-pound running shoes actually tax deductible? I mean, at first glance, it seems completely reasonable, right? Staying fit and wearing the right gear is basically essential to doing your job. But this is something a lot of taxpayers only discover when they're reviewing their tax position. HMRC takes a very different and quite strict view on what you can and cannot claim. They look at the absolute core purpose of every single item. So today, using the guidance from MTA's seasoned tax advisors, we are going to clear up these gray areas. We want to make sure you don't become an accidental target for an HMRC audit while still absolutely maximizing the deductions you're legally entitled to.
To keep you fully compliant for the 2026/27 tax year, here's a quick look at what we're going to cover. First, the holy and exclusive rule. Then, travel and workspace deductions, uniforms and laundry, music licensing and CPD, and finally, online coaching and VAT. Okay, let's jump right in. Starting off with Section 1, the wholly exclusively rule. This is literally the foundational principle for every single expense you claim. The crucial point here is that under Section 34 of the Income Tax Trading and Other Income Act 2005, an expense has to be incurred wholly and exclusively for your trade. And honestly, this is exactly where the fitness industry sits in a rather uncomfortable space compared to other professions. If an expense serves both a business and a personal purpose, which accountants call a duality of purpose, it is strictly disallowable. You see, HMRC views general health, basic physical fitness, and everyday nutrition as intrinsic human needs. So while you could definitely claim for a specialized stopwatch that you only use for client sessions, your everyday protein shakes and your general gym membership, those usually fail the test because of that clear, undeniable personal benefit.
Now that we've got the foundational rules down, let's see how this works in practice by moving to Section 2, which covers travel and workspace deductions.
These are frequently the single biggest underclaimed expenses for mobile trainers who visit clients at their homes, local parks, or hired facilities. If you're driving to these different client locations, you can claim a highly beneficial simplified mileage rate of 45p per mile for the first 10,000 business miles in your own car, and then it drops to 25p after that. Did you know that many taxpayers are completely unaware of this rule until they prepare their tax return? They miss out on hundreds of pounds of relief. Now, you must keep a contemporaneous log. That just means a live, up-to-date record of dates, destinations, and distances. But a quick warning here. Ordinary commuting, like traveling from your house to the commercial gym where you run all your daily sessions, does not count as a deductible business journey.
Okay, but what about when you're working from home? You might be writing client programs, filming content, or sorting out bookings. You essentially have two ways to claim this. The simplified flat rate gives you fixed amounts of $10, $18, or $26 a month, depending on whether you work over 25, 51, or 101 hours a month at home. It's super convenient. However, if you actually have a dedicated home office for programming and Zoom consultations, you can calculate the proportionate cost of your rent, utilities, and broadband based on the rooms you use and the actual hours of business use. Now, this actual cost method does require more meticulous record keeping, but as your business grows, it very often produces a much higher and fully legitimate deduction.
Here is a professional tip for you. Keeping clear records of your weekly gym rent or the per-session commission you pay to a facility guarantees a really straightforward deduction on Box 21 of Form SA 103. Those are direct business costs incurred purely to trade, but attempting to claim your own personal gym membership? That is a massive red flag for an HMRC audit. Unless you can categorically prove that you only use that specific facility exclusively for training clients and you never work out there yourself, that personal element makes it completely non-deductible. let's step onto the gym floor now for Section 3, looking at uniforms, clothing, and laundry.
This is a brilliant illustration of HMRC's stance. Remember those 120-pound running shoes we talked about earlier? Normal gym wear, like standard Nike trainers or just plain black leggings, is completely disallowable because of dual personal usage. Theoretically, you could wear them to the supermarket or on a personal run. If you get audited, plain Nike trainers will be struck off your expenses immediately. However, if your clothing is customized with a permanently heat-pressed or embroidered business logo, it functions as a promotional tool. It effectively becomes a uniform, and once it's permanently branded, it is a fully allowable expense.
Right. Let's talk about washing those branded uniforms, because this is a huge point of confusion. Many PAE employees in other industries are used to claiming a standard flat rate of £60 per year for uniform laundry without needing any receipts. But self-employed trainers are actually required to calculate their deduction based on realistic actuals. I really want to caution you here. You cannot just plug in a £60 flat rate as a sole trader. HMRC expects you to actually justify the figure you put on your return.
So rather than settling for a flat rate that could easily be challenged, you should calculate a realistic estimate. It's quite simple, really. First, work out the cost per wash load, factoring in your water, electricity, and detergent. Let's say, conservatively, that works out to £1.50 per load. If you do 2 uniform-only washes a week for 50 working weeks of the year, you can legitimately claim a £150 annual deduction. Keeping a simple, logical record of that calculation is exactly what an HMRC inspector wants to see. Moving right along to Section 4, let's look at the intangibles: continuing professional development, or CPD, and music licensing.
When it comes to your training, HMRC's BIM 35660 guidance draws a very clear boundary. Initial courses that equip you for a brand new trade, like your foundational Level 2 gym instructor or Level 3 personal trainer qualifications, are completely disallowable. They're viewed as the capital costs of entering a new trade. On the other hand, specialist courses that maintain or update your existing professional skills, things like postnatal certifications, first aid renewals, and your annual SIMSPA memberships, those are fully deductible revenue expenses.
Now, a lot of people overlook this next detail, but using your personal Spotify or Apple Music account for group classes actually violates their commercial licensing terms. It's a personal liability. If you're playing commercial music to clients in a class, you actually have to purchase the music license from PPL-PRS. But there's good news. Making that transition turns a liability into a business benefit. That annual commercial license cost, which is usually around £100 to £300, is a fully allowable revenue expense that you can confidently deduct from your profits.
Finally, let's navigate the digital side of things in Section 5. We're looking at online coaching software and a highly specific compliance trap regarding VAT, which is incredibly relevant for the 2026/27 tax year. For modern hybrid trainers, tech is everything. Subscription fees to client management platforms like TrueCoach, Trainerize, or MyPTHub are entirely allowable revenue expenses. And definitely don't forget the hidden digital costs. Your scheduling tools like Calendarly and those pesky payment processing fees from Stripe or PayPal. Every single time a client pays you and the processor takes their cut, that fee is a deductible expense. Be sure to capture all of these digital costs because they directly lower your taxable profit.
However, as your digital presence grows, you have to carefully monitor your rolling 12-month turnover. This is a vital number to watch. By combining your in-person sessions, your online coaching subscriptions, digital course sales, and maybe even some fitness affiliate income, you can rapidly push your total revenue over the current 2026/27 VAT registration threshold of £90,000. Crossing that threshold creates mandatory registration and VAT collection complications across all your different revenue streams. Now look, hitting $90,000 is a fantastic problem to have. It means your business is booming, but it requires immediate professional tax management so you aren't hit with unexpected VAT bills or nasty penalties for late registration.
Okay, to summarize our explainer today, the key takeaways are: always apply the wholly and exclusively rule to every purchase. Keep those contemporaneous mileage logs to claim your 45p per mile. Make sure you strictly separate personal gym use from commercial studio hire. Get permanent branding on your uniform so you can claim actual laundry costs instead of risking a rejected flat rate. Deduct all your ongoing CPD and music licensing fees. And finally, track your combined in-person and digital revenue so you don't accidentally trigger a £90,000 VAT headache.
Because every single personal trainer's business model is completely unique, and HMRC roles require really precise, customized application, we strongly encourage you to reach out to the seasoned experts at My Tax Accountant. MTA can give you the personalized advice you need to navigate these complex HMRC regulations, minimize your audit risk, and absolutely maximize your legitimate deductions for the year. Finally, please note that this explainer provides general guidance only. You should always obtain professional advice from a qualified accountant, like the fantastic team at MTA, before making any specific financial or tax decisions for your business. So, armed with this new knowledge, what step are you going to take today to make your fitness business more compliant and more profitable?